Simple, fast steps. Step number 1. Let's go over a thought experiment of normalizing interest rates and the Fed's balance sheet. What would that do to the plumbing of the financial system, therefore the entire financial system and the economy? Goes straight to the repo market. Primary dealer A, B, and C, they provide liquidity, the cash that the financial institutions and the hedge funds need. Remember, they swap overnight or for a specific term, meaning a term repo, the collateral for the cash. The repo market basically is the key to propping up the corporate funding market. If the corporations get the funding they need, then that props up the stock market. But it all goes back to the repo market. That is crucial. So let's go back to what happened during 2008 and the GFC. The real economy was over here and all these people had houses, but they got pretty upset. This guy really looks sad. Why is he sad? Because the Federal Reserve raised interest rates from 1% to 5%. So all these people with adjustable rate mortgages couldn't afford to pay. Well, let's fast forward a few steps. Of course, we know that this guy's mortgage most likely got bought by Fannie and Freddie. They turned it into a mortgage-backed sausage that went onto the balance sheet of Primary Dealer Bank B. We'll use them as an example. Primary Dealer Bank B back in 2008 was owned by a couple brothers. The brother on the left looks like his name is Lee, and the brother on the right, his name is Mon. It was very interesting. Mon was actually born in Jamaica. And although he's a white guy, they decided to give him a Jamaican name. Very interesting. So they were the Lee Mon brothers. Sorry, guys. I had a little bit too much time with that one. You can see where my mind goes when I'm quarantined. But back on topic here. So Lee Mon brothers own Primary Dealer Bank B, and they only have one piece of collateral. That's the loan from this guy that can't pay his mortgage. So it goes on to the asset side of their balance sheet, but unfortunately on the liability side, they've got some debt. They need to make a payment for $1,000. They take their collateral, go into the repo market, but the repo market says, hell no, we don't want that collateral because we know the borrower can't pay, he's going to default. So if there's no collateral, there's no repo transaction for the Lee Mon brothers. That means no cash. No cash means no payment. The Lee Mon brothers go bust. So the catalyst to the GFC is that we had this collateral source used in the repo market for funding and liquidity that dried up. It went away. But the more important point is that we had an entire system that was incredibly fragile because it was 100% reliant on this one component. I'd like to use the example of Venezuela. We all know the problems that they've been having with their economy. Well, the oil prices went down. Their entire economy was built on oil. Therefore, when oil prices go down, the economy collapses. They've got to print money, takes you to hyperinflation. Was the main issue with their economy the fact that oil prices went down? Or was it the fact that their entire economy, this whole system, was built on that one component, making it very fragile and susceptible to any shock that wasn't predicted? In 2008, we had a financial system that was exactly like the example of the Venezuelan economy. Fast forward to 2020. You may be saying, yeah, George, okay, I get what happened in 2008, but what does that have to do with normalizing interest rates and the Fed's balance sheet today in 2020? Because if we took interest rates, Fed funds, up to 6%, and the Fed dropped their balance sheet, or did quantitative tightenings. They sold their entire asset side of the balance sheet down from, call it 4.5 trillion prior to the cerveza sickness, down to 800 billion. The entire system would freeze. Let me go over one component to show you why that would happen. Remember, with collateral, that's incredibly important. That is the entire repo market. But the other side of the collateral, how much collateral is in the system, is the interest rate. Let's think this through. If primary dealer bank A has a bond that they use in the repo market, and they purchase the bond for $1,000, it's yielding 1%. Okay, great. Well, if they need $1,000 to make their payment, they take that one bond, throw it into the repo market, and let's say they get the $1,000, the value of the bond. And of course, there's spreads and whatnot. It doesn't happen this way exactly, just using this as a basic example. If interest rates normalize, let's say they go from 1% to 7% on the bond, that the value of the bond has an inverse relationship to the interest rate, as we know. So let's say the value of the bond goes from $1,000 down to $300. These aren't exact numbers, just using them for a simple example. That means the amount of collateral in the system, let's say right now it's 2.2 trillion, goes all the way down to 500 billion, 700 billion, something like that. It's the exact same thing that happened back in 2008 that caused the whole house of cards to come crumbling down. That is, we had this much collateral that shrinks down to this much collateral. If the amount of collateral shrinks down, they can't get the liquidity they need. The financial system goes bust. And that's really just the tip of the iceberg if we were to raise interest rates to 6%. We haven't even talked about the Fed reducing the size of their balance sheet, taking all those treasuries, in other words collateral, and selling them into the market, increasing interest rates even higher. But let's just leave it right there, the tip of the iceberg. Again, I don't want to go off topic because this will be an entirely separate video. But the takeaway is that if this wasn't a big deal, if interest rates rising was just, well, who cares, George, you're blowing this out of proportion. Why did the Fed come into the repo market September 17th with guns ablazing, with the bazookas, offering up to 1 trillion a day in the repo market, where we are now? And why was it that the Fed initially said that this was no big deal, nothing to see here, it's only a temporary glitch? And of course, now that we're in April, even without the cerveza sickness, the Fed would still be in there propping up the repo market. In other words, they'd be bringing interest rates in the repo market from 10% all the way down to where they wanted them, around Fed funds. If interest rates weren't propping up the entire financial system, just like mortgage-backed securities were in 2008, the Fed never would have done that. They would have kept reducing the size of their balance sheet. Remember, their actions speak much louder than their words. And we haven't even talked about the government. They are the biggest subprime borrower with an adjustable rate mortgage in human history. Every year they're rolling over or issuing at least 10 trillion in debt. What happens if their interest rates that they pay on the debt goes from 2% up to 6%? They can't afford that. The government comes crashing down. We have a GFC 2.0 plus. And that's, what's the plus? The plus is the government. Back in 2008, we had a system where the solution, quote unquote, was for the balance sheet of the private sector to go onto the balance sheet of the government and the Fed. Well, now what happens is you've got a situation where all that debt is on the government's balance sheet. They have to roll it over, and they can't. So my point is the system is far more fragile now than it was back in 2008. And if interest rates normalized or the Fed's balance sheet normalized, you would have complete disaster. That at a very minimum, it would be GFC 2.0. Step number 2. So we understand that normalizing interest rates and the Fed's balance sheet would have the same type of effect in the financial system that it did back in 2008, the GFC, if not worse, because now it's GFC 2.0 plus the government being the biggest subprime borrower with an adjustable rate mortgage in human history. So that's kind of a tops-down view, but now let's look at a bottoms-up. What would happen to the actual economy while the financial markets were struggling and having problems? Well, first, let's figure out what the wealth distribution is roughly in our population. This is for the United States. Boomer Bill is right here, and he is stoked. He's got a big smile on his face because he's got a good percentage of the pie. He's got a house that's worth $500,000, a 401k. It's got $250,000 in it. His wealth is $750,000. Then we've got Gen X Jake. He's kind of right in the middle. He's doing all right, but not doing that great. He's just got a house on his balance sheet. He's only worth $150K. That's how much wealth he has. Then it goes all the way down to Moody the Millennial. And it's not he or she, of course, because I haven't figured out their personal or their preferred pronoun, but they do have blue hair, as you can see. And they don't have a lot of assets, but they have a Prius that's worth $5,000 and a bicycle that's worth $75. But Moody the Millennial has the one thing that Gen X Jake and Boomer Bill don't have, and that is a safe space. And just like the MasterCard commercial always taught us, that safe space with the little dog, the book, and the flowers is priceless. But back to my original point, in the shared distribution of wealth, the boomers in our society have 57% of the overall wealth. Of course, most of that is in their home equity and the stock market or bond market. Generation Xers have about 16% of the wealth, and the millennials only have about 3% of the wealth. So if interest rates go from 0 to 6%, of course the price to earnings multiple in the stock market would also have to adjust. Let's say the CAPE ratio was at 30, and again I'm going back before the cerveza sickness, it would most likely go down to around 15, or stock prices would get cut in half. Also, home prices. If you look at a mortgage calculator and type in the current interest rate or mortgage rate, about 4.5%, if that goes up by 600 basis points, call it 10 to 10.5%, the monthly payment doubles at a very minimum. Therefore, it would be most likely that home prices would get cut in half because it's all about the monthly payment. Well, if the wealth for the baby boomers and the Generation Xers gets cut in half, what does that do to consumer spending? And of course, in the economy as it's set up now, one man's spending is another man's income. So if there's a lot less spending just because they don't have the purchasing power anymore, the GDP goes down substantially. If the GDP goes down, unemployment goes up, and tax revenues, going back to the big problem the government has, would also go down. And I could get really technical and explain this to you with charts and graphs, but I think it's easiest just to look at two charts, and I've kind of combined them into one. That's the overall outstanding debt in all sectors in the United States. So this is consumer debt, sovereign debt, is all the way up to almost $80 trillion, right about 75, a little over 75 trillion. But what is the income? What source of revenue or what resource do we have to service the debt? Well, that's GDP. Look at where GDP is, 23 trillion. And if you notice, these charts go back to 1950. And the GDP and the debt in the overall economy at the sovereign level and the private sector was pretty much the same, if not GDP a little bit higher. And then after 1980, they completely diverge. GDP grows, but at a much slower pace than the debt that goes completely parabolic. So you may be asking yourself, okay, George, how is that possible? How does it work? I know if my income is $50,000 a year and my debt goes parabolic like this chart, I can't afford my monthly payments. But remember, what has happened since 1980? Interest rates have continually gone down. We've been in a 40-year down cycle in interest rates. This has allowed us to increase the debt exponentially while the income or the ability to service that debt hasn't grown at the same pace. In other words, our entire system, the entire economy, is based on extremely low interest rates. If interest rates went from 0 to 6% or increased in the overall economy, whether it's credit cards, mortgages, auto loans, if they went up by 600 basis points, it would be time to pay the fiddler. The exponential growth in the debt would have to come crashing down to some level where it was serviceable by the amount of income in the economy. The problem is you'd have a doom vortex. As the debt comes down, so would the income, because as we all know, the economy is built on three things: asset bubbles, debt, and confidence. If that debt is coming down, so are the asset bubbles, so is the confidence. And to understand this even better, let's go to a recent interview with two of my good buddies, Luke Groman and Eric Townsend. This is a recent episode of one of my favorite podcasts on the Rebel Capitalist Show, Macro Voices.
If the Fed just let markets work like Powell said he wanted to do, repo would go back to 10% or more, and the U.S. government would need to roll $6 trillion or so in the next 6 months at 10% plus. And the U.S. government cannot afford to roll $6 trillion at 10% plus, especially since at 10% plus, the highly financialized U.S. economy would collapse. So the financing needs would non-linearly go from 6 trillion to 8 trillion to 10 trillion over the next 6 months as tax receipts collapsed. And mortgages would be at 12% plus, so you'd have housing collapsing. Banking system would likely quickly follow. Corporate debt issuance would grind to a halt with repo at 10%. They can't afford to roll any of that stuff at 10% plus. So record U.S. corporate debt issuance would begin defaulting, which with corporate leverage as high as it is could easily quickly wipe out significant portions, if not the majority, of the equity market cap of the United States and the world. And remember, as we've noted multiple times, in the U.S., equity market cap's 160% of GDP, and net capital gains plus taxable IRA distributions alone are around 200% of annual growth in personal consumption expenditures, which itself is 2/3 of GDP. So, in plain English, there's no economy in the U.S. or the world if U.S. stocks crashed. And that's not hyperbole. That's just sixth grade math.
Let me ask you a quick question. If the Fed would not have raised interest rates back in 2005 or 6, whenever they raised them from 1% to 5%, would we have had the GFC? Would those subprime borrowers been able to actually make their payments? Would home prices continually have gone up? Maybe we could have avoided the entire GFC by keeping interest rates low and gradually taking them down further and further and further until they got to zero and just stayed course. Maybe we could have avoided the entire thing if we just would have started quantitative easing, ZIRP, or maybe even negative interest rates. Then we never would have had a housing bust. But just because we might not have had a bust, it doesn't mean that the system back in 2008 was stable. And of course, we know that looking back in retrospect, because once they took interest rates up to 5%, they tried to normalize, the entire system came crashing down. Well, why is today any different when the debt in the system, the government debt, the state debt, the corporate debt, the consumer debt, is far greater than it was in 2008. My point is the system was broken back then, and it's even more broken, more unstable, and more fragile today. Just like mortgage-backed securities were the pin, the catalyst in 2008, along with interest rates, the pin and the catalyst today is just the cerveza sickness. That's not the cause. And we know that by going through step 1 and step 2 in the thought experiment of what would happen in the financial markets, in the financial economy, and the real economy if we just took rates and the Fed's balance sheet back to where they were in 2007, 2008. The real problem isn't the pin or the catalyst. It's the structural problems, the underlying problems we have with the economy itself. And whether it was mortgage-backed securities, the cerveza sickness, it doesn't matter. Sooner or later, a system that is broken will finally break. Step number 3. Now it's time to answer the question, can the Fed reinflate the everything bubble? We learned in steps number 1 and 2, the U.S. economy is a lot like the movie Shallow Hal, in the sense that you think you're dealing with a smoking hot chick, then boom! All of a sudden you get blindsided by the cerveza sickness and you realize that you've actually got Gwyneth Paltrow in a fat suit. Ugh. That takes you straight into the no bueno zone. But to understand the probabilities and the possibilities of the Fed pulling this off, we need to understand their game plan. In my opinion, it's to buy everything in sight. I'm talking about equities, debt, real estate in the form of mortgage-backed securities. They're going to try to get it all onto their balance sheet. As an example, they just set up the FEMA program. And that's not the disaster relief. That's Foreign and International Monetary Authority program. Basically, it's the repo market outside of the United States. The Fed says to all the central bankers, whoa, 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 time out. Do not sell those treasuries. We'll take them, put them onto our balance sheet. We'll give you the dollars you need to satisfy whatever dollar-denominated debt you have outstanding. I think the Fed's going to do it to the entire system outside the U.S. and inside the U.S. Going to go to the primary dealers. Guys, anything on your balance sheet that might take a haircut, we'll go ahead and take it, put it onto our balance sheet, give you 100 cents on the dollar. They even go to the individuals in the private sector, buy their bonds, buy their equities. Really, the goal is if everything is on the Fed's balance sheet, there's never a seller. If there's never a seller, the price doesn't go down. So you've got real estate in the clouds, all the bond markets in the clouds, and the stock market still stays in the clouds. The Fed achieves their objective of reinflating and maintaining the everything bubble. For a little bit more of my insight, let's go to a recent interview I had with RT Television.
There's one guy who's making a big name for himself, providing both micro and macro econ lessons almost every single night on YouTube. In fact, I'll just full disclosure here. When I go home at night after doing 22 newscasts in a row, I slump on the couch, sometimes with an adult beverage, and I watch his segments to learn a thing or two, and maybe you could too. I want to introduce you to him. His name is George Gammon, and he's good enough to join us now to kind of help us understand this. So, George, if you would just take it away. What is your take on this situation we find ourselves in?
Well, I think the economy is going to struggle on a moving forward basis. What we've done is we've inflated what we all call the everything bubble, and that's a direct result of the Fed and their intervention going back to the late 80s. It doesn't start with Powell, that's for sure. But if you go look at the dot-com bust, they tried to fix that or paper over it by inflating another bubble. That was a housing bubble. Then in 2008, 2009, they had to create another asset bubble. And that was where we are today. And what they're trying to do, in my opinion, is get as much of the private sector balance sheet onto their balance sheet. Because if you have, let's say, equities or bonds, any type of asset on the Fed's balance sheet, since they don't have a profit and loss, if those assets take a 50% haircut, then theoretically it's not going to affect the economy. And because the economy is so dependent upon those asset prices staying high, I think that's pretty much going to be the Fed's game plan. So the question really becomes, what are the knock-on effects of the Fed taking their balance sheet to 10 trillion, 20 trillion, you name it. And I think the release valve there long-term is definitely going to be the dollar. So to answer the question, can the Fed reinflate the everything bubble? I would have to say yes. Actually, I think it's possible. I don't think it's probable. But what we have to remember is even if they do reinflate the everything bubble and asset prices go right back to where they were way up in the clouds, it doesn't mean they've fixed the economy. The economy is still broken, just like it was in 2008. In fact, it's even worse now. It's more broken, more unstable, and more fragile. The drug addict needs its fix. That's exactly what the economy is like. It's like a drug addict laying out on the street, eyes crossed, just waiting for the next round of money printing. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.